Good morning, everybody. Welcome to the QOZ Tax webinar. I say good morning. It's 11 o'clock here in Chicago. I suppose in East Coast, it's already noon today. Nonetheless, my name is Michael Episcope. I'm co-founder and co-CEO of Origen Investments, and I'm here with John Hoffman from Bracket Partners, a CPA and QOZ tax expert. And it has been said that the only two certainties in life are death and taxes. And that was kind of before QOZ came along. Now, QOZ obviously doesn't help you live longer, but it can certainly help you substantially on the tax side. In today's webinar, is really about clearing up a lot of confusion about the program itself. There's a lot of nuances to the program, speculation, especially now that Democrats are controlling the White House, and just general questions about how the QOZ program operates. And what we hope to do today is answer as many of those questions as we can. And we certainly thank you for your questions in advance. This is going to be about a 1 hour webinar where John and I are going to talk for about 30 minutes. John is going to do most of the presentation as he is the QOZ tax expert today. And then we're going to follow it up by a live Q&A. So if you have questions along the way, just go into your chat box and ask the questions, and we'll get to those as soon as we can. But we've tried to anticipate most of your questions along the way. So hopefully those will be answered by the time we get done with the 30-minute side. Now, with that, John, if you want to give a brief introduction of yourself to the audience, that would be great.
Great. Well, thanks, Michael. Hi, everyone. My name is John Hoffman. I'm the president and founder of Bracket Partners, a firm I founded about 2 years ago. I work with a wide variety of clients, primarily in the real estate and fixed asset space with various tax incentives, credits, and so forth. And one of the areas that I've been pretty heavily involved with since tax reform in 2017 was the new Opportunity Zone program. So I've worked with a pretty wide variety of opportunity funds, investors, real estate developers, operating businesses, and so forth that have structured funds, invested in funds, and really just done a wide variety of work in this area. I typically work alongside various attorneys, especially tax attorneys, and then some larger opportunity funds, and then a lot of smaller individual funds, and kind of everything in between. We've seen this program, evolve over the last couple of years, and it has matured, but it's still a very new program. It's a new incentive. So although we do have a lot of clarity because the IRS has issued significant guidance, we're not going to have all of the answers for you because, there still are a lot of questions that are outstanding. But overall, I think that the focus of the program, the focus of the marketplace as a whole has been such that as long as you follow the overall ideals of what the program is going to be, in general, you're going to be eligible for the tax benefits of it. But of course, with anything tax related, I guess the devil is in the details.
Well, John, thank you so much for that. And we've enjoyed a just great symbiotic relationship with John and Bracket Partners. And certainly we get a lot of questions that pertain to QOZ tax law, and we are not QOZ tax experts ourselves. Certainly we are when it comes to compliance with the fund and that side, but not on the investor side. And we always tell people that if you have a question, please consult your tax attorney, your tax expert, and for those who don't have them, we always send them over to John. So it's been great. John, why don't we just jump in here? The basic webinar outline that we're going to follow today is we're going to cover some of the fundamentals. We're going to talk about the common QOZ tax questions. We've got 30 that were emailed in. We've got another 10 that we've sort of identified. We're going to talk about then the future outlook on taxes, but not really like from a crystal ball perspective. But a lot of people ask what happens, to the program if taxes go up, right? And how does their individual situation become impacted as a result of that? So to the extent that we're going to look at taxes and how they impact maybe the benefits of the program, and then we're going to open it up for live Q&A after that. So John, let me hand it over to you. If you can kind of set the table and lay the foundation for the QOZ tax benefits. Let's start there.
Sure. So I think probably many of you know, but the program provides three primary tax benefits. And on the slide that we have there, you can see the three that are basically up there. By far, the biggest benefit is the first one that's listed there. That's tax elimination. So what that means is that if you invest your capital gains in an opportunity fund, and that opportunity fund does what it's supposed to do, and there is a appreciation of your investment, and you hold it for at least 10 years, effectively at the end of the day, you pay no capital gains on that appreciation. So if you were to put in $1 million, and then after 10 years, it's worth $2.5 million, you have $1.5 million worth of gain, and all that $1.5 million is excluded from taxes. So that's by far the biggest benefit of the program. The second benefit there is listed as tax deferral. And really what this means is that you generated a capital gain that you want to invest in an opportunity fund. You have the choice to pay the tax on that gain now, or if you invest that capital gain, you get to defer that capital gain as far out as 2026. But you will have to pay the tax on what we call the old capital gain or the prior capital gain. So you can't completely escape capital gains tax through this program, but for the tax that's due on your old gain, you get to defer it as far out as the 2026 tax year, which leads us into the third benefit. So the IRS and Congress, as part of this program, they are allowing you to not only defer the taxes on the old gain, but they're also letting you reduce that. And what we have noted here is the way the program is written right now, you can reduce that capital gains tax on the old gain for up to 10%. Prior to 2019, you were able to reduce up to a total of 15%. But because of the way the program was structured, now that benefit is down to 10%. So for a very simplistic example, if you have $1 million in capital gains, let's just assume that the capital gains tax rate on that is 20%. So it's a $200,000 capital gains tax that you would owe. If you invest that $1 million into Origen's Opportunity Fund, you will pay the tax on the old gain in 2026, but instead of paying $200,000, you would pay $180,000. And then assuming that that $1 million investment increases to be worth $2.5 million 10 years from now, you will not pay any capital gains tax on the $1.5 million worth of appreciation.
Right, and John, maybe you can, the step up in basis, you take the investors through the arc of that going forward in the next couple of years. When does that go to zero? What is 2021?
Yeah, so the way that the IRS was able to basically accomplish the goals that Congress wanted to set up here was they basically allow you to step up in basis your effectively your gain in 2026. So that's how you get the 10% benefit. And then in 10 years from now, you basically are able to step up your basis to whatever the fair market value would be. So that's effectively the mechanism that they go through to, for you to avoid to have to pay capital gains tax on the appreciation.
Yeah, and that's 10% this year, 10% next year, and then goes to zero after that. Is that correct?
Yeah. So what's happening right now is the way the 10% works is that you have to have your money in an opportunity fund for at least 5 years to get that 10% step up in basis, and it's effectively 5 years. And if you count back from, well, when does that 5-year clock start? It starts basically 5 years back from 12/31/2026. So as long as you get your money into the fund, basically here this year and so forth, you're going to get that 10% step up in basis. But let's just say that, we're looking in the future in a crystal ball. Let's say you have some capital gains in 2023. And you put that money in an opportunity fund. The way the program is written right now, you're going to pay the taxes on those funds in 2026, and you will not be eligible for that 10% reduction because you wouldn't have had your money in the fund for 5 years leading up through the end of 2026. We don't have to worry about that right now, but that is something that we need to consider, particularly in future years, if the program doesn't get changed.
Well, yeah, and I asked it because I know like last year there was a rush to get money in by December 31st because the step up in basis went from 15% down to 10%. So people are trying to capture that extra 5%, but there's no risk of that this year. 2020 and 2021 will both be 10%.
That's right. Now there could be another kind of mad rush at the end of next year, right? To get into that 10% if the program doesn't change.
Yeah, we right. When that goes to zero, that'll be a big rush. Okay, let's get into the what we have here are 8 of the what we have deemed as the most commonly asked QOZ questions, and really, I think by going over these, 80% to 90% of all the questions will be answered today, and then we certainly have a lot of great questions that are extremely nuanced and detailed that I think everybody will want to kind of tune into, and probably questions they didn't even know to ask. So John, why don't you just kind of go through these things one at a time, maybe, spend a minute on each one of them, and we'll continue going on from there.
Sure. And just there's a couple other points I want to make before I get into these questions here. That's pretty critical. And I think most of you folks that are on this webinar listening to it, you know it, but remember that the Opportunity Zone program, the benefits that come through this program are only related to eligible capital gains. So in order for you to get these benefits, and all these questions are going to relate to specifically to capital gains and when and how you invest in the Opportunity Fund. So I just want to make sure that's clear, because I still get a lot of questions about, well, I have $500,000 worth of capital gains and I have $250,000 of additional money. Can I put it all in and get the benefit? And the answer is you only get the benefits for the capital gains that you invest into the Opportunity Zone Fund. Remember that you do have to invest in an Opportunity Zone Fund in order to get the benefits, okay? That sounds probably somewhat obvious, but I've seen some questions that people have asked and said, well, what if I don't invest through an Opportunity Fund? What if I just invest into an entity and that entity has some other dollars from other capital gains or other opportunity zones? The answer is you must invest through an Opportunity Zone Fund in order to get these benefits.
And the John, last comment, your audio was breaking up a little bit there, so I missed that, and I'm sure the audience did as well.
Okay, so I'll just repeat that you must invest through the Qualified Opportunity Zone Fund in order to get the benefits. So, and you only get the benefits if they are qualified capital gains. So keep in mind that you can't just invest in a piece of property that happens to be an opportunity zone and hope to get the benefits. You must invest through a qualified opportunity zone fund. So that's key. One additional point that I want to make on here is that, many of you will have capital gains, whether they're short-term or long-term, and you'll look at those capital gains for, the 2019 or 2020 year, and you get to pick and choose how much of those capital gains you actually want to defer in a qualified opportunity zone fund. So if you have $1 million worth of capital gains, you can invest, $100,000 or $500,000 or $750,000 or the full $1 million, but you're only going to get the tax benefits on the amount that you invest in the qualified opportunity zone fund. That might be kind of basic, but it's important to note that. I think probably some of you have done 1031 exchanges and so forth in the past, and we've had a few questions related to 1031s. It's important that this program is a little different for sure for 1031s. So it does give you more flexibility. So with that, let's get into John, some of these questions here. What's that?
Yeah. I was going to say, maybe you could just talk about mechanically, because I know this is a big point of confusion. So everybody's got a lot of investments and they're all piling in from different sources. And so how do you actually deem the capital gains from one source into the qualified opportunity zone fund while leaving others out, right? So if I've got an investment that has short-term gains over here and one with long-term capital gains and one, like how does that work mechanically for somebody to peel them out and say, I want these gains directed towards the fund?
Yeah, how it works is one of the tax forms that's out there, that if you've already invested in qualified opportunity zone funds or you're contemplating doing it, you have to fill out form 8949. And on that form, it basically highlights what are your short-term capital gains and what are your long-term capital gains for the year. And then on that form, you get to decide of that. Let's just say you had $1 million worth of short-term capital gains. You get to decide how much of that short-term capital gains you want to invest in the fund. You note that on the 8949, and then you also note that on the form called 8997. You don't have to specifically say, I'm taking the gains from this particular short-term investment and this particular short-term investment. You just basically say, hey, I have all of these gains from the short-term investment or that are short-term capital gains. And you basically say, I'm going to make the election to defer all of it or a portion of it. And you note that on the form.
Okay, thank you. Yeah, I know mechanically a lot of people have questions about those. It's a little bit in the weeds, but all right, let's jump into the questions, maybe a minute on each. Are my gains eligible?
Sure. Okay, so are my gains eligible? This is probably the most common question that everybody has. And the program has been, in general, in the both proposed regulations and the final regulations, it's been pretty flexible to say just about anything that's capital gains, whether they're short-term or long-term, and qualified 1231 gains are generally eligible. So for the most part, if you are, you're talking with your tax advisor and you say, I have some capital gains here, in general, the vast majority of the capital gains are going to be eligible. You can imagine these things are, you sell stock, you sell a partnership interest, you sell part or all of a business. Let's say you're selling real estate. And another common area would be is you're invested in partnerships or corporations, and you are allocated capital gains, whether they're short-term or long-term. All of those items are generally eligible to be invested through the program. One additional comment I want to add to this, and this came up in some of the questions that we've seen, was what about qualified dividends or capital gain dividends? And the IRS has not specifically addressed qualified dividends yet. We think the answer to that is probably no, although they haven't addressed it. However, the IRS has said, even on their website, that capital gains dividends from a regulated investment company or a real estate investment trust do qualify. So if you're looking at, if you have that specialized type of capital gain, I think you'd want to do a little further investigation on it.
Great. All right, what if I have capital losses during the year?
All right, so this was, I would say, a gift that the IRS put out in the last round of, or in the final round of regulations last December when it issued. Initially, what the plan was that you would have to net your losses from your capital gains, and you would only be able to invest the net amount. And the IRS changed their tune, and it has become much more taxpayer friendly in the final regulations. So you could have a situation where you have $100,000 worth of capital gains, but you have $1 million worth of losses. You can still elect to defer all of that $100,000 worth of gains, and then have a loss on your tax return and either carry that loss forward or backward, depending on your own tax situation. So that's very beneficial. Prior to this final regulations, the IRS, it was very restrictive, and they kind of backed themselves in the corner where you would almost have to wait to the end of the year because you'd have to know if you had any losses from the year. But in what they did with the final regs was, once you have a capital gain and you know about it, you can make that election regardless of how many losses you have in a year.
Right. Yeah, it definitely beneficial, and that's a question we got quite a bit, and it's a great answer. So how does it work with short-term and or long-term capital gains? I'm not sure I quite understand that question, but
yeah. So this gets to the question. A lot of people have short-term capital gains and long-term capital gains, and you can certainly defer both of those gains through the Opportunity Zone program. However, as I'm sure many of you are aware, the tax rates for short-term capital gains are higher than long-term capital gains. So the question has come up many times is, well, can I decide to defer short-term capital gains versus long-term? The answer is yes, you have flexibility, but you have to keep in mind that the tax that you'll pay on those short-term or long-term capital gains, that the tax treatment of those will stay with you until 2026. So what that means is, let's say right now I decide to defer short-term capital gains through an opportunity zone fund. In the year 2026 and your 2026 tax return, you will have to pay the short-term capital gains tax rate on that, okay? And then the same thing would be said for the long-term capital gains. So if I defer, if I have long-term capital gains right now, I know the rate is, let's say 20%, right? When in 2026, when the tax on that is due, I will then have to pay whatever the long-term capital gains tax rate is at that point.
Great. How much, let's talk about the 180-day rule here for a minute. How much time do I have to invest? And I know there's been some changes via COVID, but I'm also assuming that next year this is going to go back to normal, right? Can you opine on that?
Sure. So the 180-day time frame is probably another really important thing to the vast majority of you that are listening to this. And it's not, unfortunately, 180-day sounds very simple, but when that 180-day time frame starts is not that simple. So let's go through, a couple of examples here for this. It really depends on the source of the gain and where it comes from. So, and then I'll get into, how the, in Washington this year, Congress and the president have made some accommodations because of COVID. So the 180-day clock will start and end differently depending on the type of gain that you have, meaning where it's sourced from. So let's just say that I have stock that I sold. I bought it, through E-Trade or whatever, and I sold it on a given date. Okay, let's just say I sold it on June 1st of 2020, and I personally sold it. And I have a gain. I have 180 days from that June 1st date in order to invest my gain. Okay, I'm not going to get into the COVID relief. I'll touch on that in a minute, but you generally have 180 days from when that happens. Okay, it's very straightforward. Let's say that on June 15th, then I sell my interest, my partnership interest that I have. I sell it and there's a gain on that. You also have 180 days from that. So that's very straightforward from when that happens. But that means that if you have capital gains that you have incurred, let's say within the last 6 months or so, you better look real closely because your 180-day window may not be extended, but for the extension that Congress has put out. However, the 180-day time frame is a little different if you're getting capital gains through a partnership or through a corporation. So many of you may be invested in partnerships or corporations, and let's say you get a K1 that comes out in March of the following year, and it allocates you certain capital gains, whether they're short-term or long-term. When your 180-day time frame starts for that is actually much different versus if you were just selling stock personally. In general, you have some flexibility, but in general, it can be 180 days from when that capital gain actually occurred. It could be 180 days from the end of the tax year. So typically that's 180 days from, let's say, 12/31/19 or 12/31/20, or it could be 180 days from when the timely filed return would be. So let's say 180 days from March 15th. So it's really important to understand, how did you get your capital gain? Did it come through a partnership or a corporation, or is it just from you selling an asset outright? So that's how the rules have been set in the final regs. However, as we know, because of COVID, there's been all kinds of guidance that has been published to give taxpayers relief for both opportunity zone investors and opportunity zone funds. So that kind of gets into our next question, but it ties into this 180 days. So what the guidance has said is that if your 180-day window would have ended basically starting April 1st of this year, you have until the end of this year. So let's say your 180-day window might have started in late November of last year, okay? That means it would have ended in April of this year. Instead of ending in April of this year, you now have until the end of the year. So you get much more flexibility with that. However, what Congress didn't do, unfortunately, which I think they should have done, was they should have just done it for the whole year. So if you had a 180-day window that ended in March 15th of this year, too bad, you're out of luck. Basically, the guidance that Congress provided and the IRS issued does not help you. But if you did have your 180-day window ending April 1st or later, basically you have to the end of this year to get your money into a qualified opportunity zone fund. Now, it's certainly possible that Congress, as they're talking about additional stimulus now, they could provide some further clarity to this and make some additional accommodations. But as of right now, if your 180-day window ended from January 1st through March 31st of this year, unfortunately, I'll call it the acts that were passed here for COVID do not help you.
Great, thanks. Yeah, that's a really important important point, because there are probably a lot of people who are even listening to this webinar today who have capital gains that they can put to work that they may not even know they can put to work. So yeah, Congress gave out just a lot of relief as a result of COVID this year to both funds and investors. All right, let's jump to the next question. Do the QOZ benefits help with my state taxes?
Yeah, so with the state taxes, it's pretty interesting. When this program came out and was starting to be really adopted in 2018, various states had to make a determination whether or not they're going to adopt the program as is, or make some changes to it, or not adopt it, and so forth. And I think probably some of you or many of you are subject to Illinois income taxes. Fortunately, Illinois has adopted the Internal Revenue Code for this particular program. So if you're eligible for, to defer the capital gains for federal purposes, you're also eligible for state. A complete polar opposite of that would be California. As you're probably aware, California has some pretty high taxes overall. They have not adopted this program at all. So you would still be liable to pay for, your capital gains tax in the year that it was recognized. And then you also don't get the benefit, the long-term benefit of this as of right now, for an exclusion on the appreciation that will result in capital gains tax after 10 years. That's the way the program is right now. Obviously some states like Texas and Florida, they don't have an income tax rate, or they don't have income tax. So, if you're taxed in that state, it's a non-issue. But it really is state by state. I wish there was some easy way to say, every state except for California adopted it this way. That's not the case. You really have to check with your own tax advisor, and you have to do a little research to determine whether or not it's going to impact you negatively, or if they're just going to follow the more favorable federal program.
Yeah, state by state. So John, for many people, this is a 10-year commitment or more. Some people are going to be in the program 20 years, and a lot can happen. And the next question is, what happens if I die or need to sell my QOZ investment early?
Yeah. So this is another really key question for people that, from day zero, people have asked. And to a certain extent, the question about if the taxpayer actually dies earlier, in general, the regulations, I don't think have done a great job specifically addressing this crystal clear, but generally it appears that your estate and your heirs get a stepped up basis for this. And it's, most importantly, it's not an inclusion event. So what that means is, if you die, it's not an inclusion event where you have to pay the taxes at that point, and you're excluded from all of the opportunity zone benefits. I know some of you are likely to, invest in this fund directly, or you might invest it through a trust, and there's a wide variety of other estate planning concerns that you might have out there. So it can be very much facts and circumstances depending on, how you've structured this. But that's generally how the program has laid this out. I think a lot of folks would say, well, I'm married, and what about if I die first? Does then it go to my spouse? And it's not an inclusion event. And generally the answer is no, it's not an inclusion event. But I will say, I don't want to say that there aren't situations where it could possibly, there could possibly be an adverse tax effect. So let's flip to the other part of this question. And what if you need to sell the investment early? And I think that could happen for a wide variety of reasons why you might need to sell. I think that just about every opportunity fund that I've worked with has made it such that it would be very difficult to sell prior to 10 years. It would have to be some very extenuating circumstances for that to happen. Because, in order to do that, that's basically a capital event for the fund. They have to figure out, well, how are we going to do this? How are we going to finance that, and so forth. So there's a lot of issues that a fund has to work with, whether it's a real estate business, whether it's a real estate investment or an operating business. And for you, generally, if you're an investor, and in general, if you have to sell your investment early, it is an inclusion event, and you're highly unlikely to be able to preserve that 10-year benefit. So obviously, if you've made it through the 10 years, and then you decide to sell, then it's really up to the fund itself and, what the operating agreements and what you negotiate with that fund and so forth about how that works. But you've hit through the 10 years. The same question could happen is, well, what happens if I invest now and I have to sell my interest before 2026 for whatever reason? Well, if that's the case, in general, you're going to have to pay the taxes. I think the question comes up a lot and says, well, what about if I sell my investment and then I happen to invest right away in a different opportunity zone investment, somebody else's? That answer, the IRS has done, I think, in my mind, a very poor job of trying to answer what that looks like, because what they don't want to do is have people cycling money from one fund to the other. The whole purpose of this program is for investors to get these capital gains tax benefits, but to invest the money into lower income areas and have long-term patient capital that makes meaningful investments in these areas. What they don't want to do is see people cycling money in and out. And I think, Michael, you could probably highlight how you at Origen have said, look, we basically want to lock your money in for 10 years. And you might want to highlight, what you've done with that.
Yeah, and then the question might have to do a little bit with our fund in particular, so I'll answer that question. But you're absolutely right. When people think about this, they should think about 10 years in a day at a minimum. Our fund actually has liquidity where you can stay in longer if you'd like. And we do have, under certain provisions, the ability for people to get out, but there's a penalty, and it ticks down year by year. But we also understand that circumstances change, but that penalty, it declines over a 10-year period. So if you have to get out in year 5, for example, you might pay a 5 or 6% penalty, but it's also not guaranteed. It's a best efforts. And certainly we have to make sure as the fund manager that we maintain compliance, so that nothing we're doing, if people actually are trying to redeem at that point, we want to make sure that our fund is in compliance for the other investors who are in the fund. So, but we do, circumstances change, and we realize that death, divorce, bankruptcy, these things are, part of daily life.
Right, and I think another important point to this question is that, we're doing a lot of Q&A here strictly related to people investing in the underlying opportunity zone fund, right? But the thing is, once you put your capital gains into the opportunity zone fund, there's really not much you have to do from a compliance standpoint and so forth. There's an extra tax return form that you have to file each year with your taxes. But as long as you just leave your money in there, there's not a whole lot you have to do. On the flip side, Michael and his team at Origen and every other opportunity zone fund, there is quite a bit of compliance that has to be done every year to make sure that the fund and the underlying entities are doing what they need to do from the standpoint of not only generating a return of your investment, primarily appreciation, but sometimes cash flow as well, but making sure that they're following all of the rules that the IRS has laid out thus far. So, just keep in mind from your investor, as an investor, generally once you get your money into the fund, as long as the fund does what it's supposed to do and you file the appropriate forms each year, there's not much else that you have to do. It really all relies upon the fund itself and Origen's teams and so forth. So that kind of gets into the last of the 8 questions that we have listed here, although we do have many more that we're going to go over. Is what additional tax forms do I need to file? I think we kind of touched on this before. Obviously, you're going to have your Schedule D for your 1040. You're also going to have Form 8949, where you list what are your short-term capital gains, what are your long-term capital gains. And then on that form, you note of those capital gains, which ones are you deferring? What is the description of the fund that you're investing in? When did you invest in that fund, and so forth. So that needs to be shown properly on the 8949. And then the other form that's new, that's come out as this program, is the Form 8997. And 8997 basically says, okay, I'm investing in a opportunity zone this year. Here's how much I've invested. And then you will fill out this form each year. Here's how much I've invested. Here's how much I've sold. And or here's how much I continue to hold in an opportunity, qualified opportunity zone fund. So that form you'll need to fill out each year with your taxes. I do want to make a couple of comments, though. I've worked with a variety of my CPA firm brethren and quite a few clients this year in helping prepare these forms. The descriptions that are in there and the instructions and so forth, there's some conflicting information. And I would anticipate that the IRS, either electronically or even manually, will be sending taxpayers various questions because the way that the forms are written, and to a certain extent how they need to be filled out, there definitely is some improvement that needs to be made from the standpoint of clarifying things. So if you happen to get a notice from the IRS and it says, hey, we have a question on this and this and this may not be properly stated and so forth, don't get upset with your tax advisor or whoever it might be, because the forms, quite frankly, need a lot of improvement as far as both the directions and how they're written. And I do expect that for the 2020 tax year, when these forms are improved upon here in the next couple of months, that they will be changed somewhat and be easier for all to fill out. One other comment I want to add to this is that, when you talk about tax forms that need to be filed, that's, what we had to do for this past year. It's likely to be similar for 2020. There is quite a bit of pressure in Washington and really throughout the country that looks at this program, that there likely will need to be additional reporting requirements. I think it's probably going to be at the fund level. And, for example, if you do a real estate project and it's in an opportunity zone fund, I think there's probably going to be additional reporting requirements that come out that'll say, how much did you invest? How many jobs did you create? So on and so forth, to look at the overall impact of the program. That hasn't come out yet, but I think that, over time, Michael, this is probably no surprise to you and every other opportunity fund that's out there, that there is likely to be more reporting that the fund is going to have to do. It's possible that investors may or may not have additional reporting requirements as well.
Yeah, we're keeping an eye on those regulations, and certainly that's something that that Congress has talked about changing, are the reporting requirements. So, as of now, we don't know what that looks like, but we're ready to, comply. So let's, John, here, let me see. I'm freezing up here. Oh, let me go back one. So let's talk. We have the future outlook on taxes. And I know we get a lot of questions on this as well. And this is something we've tried to address in our earlier QOZ webinars. And our role here isn't today to opine on what Biden is going to do, where taxes are going, but it's really to look at things from a risk basis, right? And so the question I have, like based on this slide, and this is, you can kind of talk about what the slide is, but is the program more beneficial if taxes go up or less beneficial if taxes go up? Because we've had some investors who, have said, look, I think taxes are going up, therefore I don't want to invest, right? And others who have said, you know what, I think taxes are going to go up, therefore I'm going to, back up the truck into this program and put as much as I can into it. So maybe you can shed a little bit light on this and then explain what the chart is in front of us.
Yeah, right. And like Michael, you said, we're not going to use a crystal ball to pick to determine where tax rates are going to go at all. But I do think this chart was interesting when I was kind of doing a little research for this. This shows what has happened to the federal capital gains tax rate over the years. And you can see that the rate has really bounced all over the place. But really over the last 20 years, it stayed within that 15 to 23.8% range. Obviously, that could go significantly up. It certainly could go down. We don't know what it's going to look like. But you can kind of see where capital gains tax rate has been over the years. I know it's not really the focus here, but it was really low right before the Great Depression and really high when that started. And after that, it's kind of bounced around a little bit, but generally over the last 20 or so years, it has been lower. So what does this really mean if you're contemplating a opportunity zone investment, you have capital gains, and you think that capital gains tax rates are going to go higher? Based on some numbers that I've run, and I've looked at what other CPA firms have done, I've looked even at what other tax attorneys have talked about. I've obviously had discussions with Michael and other opportunity funds that I work with. And I think the general answer is that if capital gains, long-term capital gains tax rates go up, there's actually still a significant benefit for being in an opportunity fund. That being said, if capital gains tax rates were to exceed probably 50%, which is really high, then the benefit may diminish, or there may not be a benefit of doing that. So the answer, unfortunately, kind of depends. I mean, do we think that capital gains tax rates are going to go over 50%? I guess that's possible, but that is probably pretty unlikely. But if capital gains tax rates go up into the high 20s or 30s, are you still better off with or investing through an opportunity zone fund versus not? And generally, the answer is absolutely yes. The other thing I would argue is that if you're investing through a qualified opportunity zone fund, I think you're generally doing that because you think that the value of that investment, meaning the appreciation long-term, is going to be very significant. If you don't think that's going to be the case, you're only doing this because you want to defer taxes and so forth, you might have a different answer. But if you think that the overall value is going to appreciate significantly over 10 years, then the benefit increases significantly for you to invest through the qualified opportunity zone fund. Obviously, none of us have a crystal ball to know what capital gains tax rates are going to look like 10 years from now. But I think that as long as those long-term capital gains tax rates stay in the, let's say, mid 40s or less, generally the benefit of investing in an opportunity zone fund is going to easily exceed what it would be if you didn't invest through the fund. Now, I will say that I've gotten some questions and seen other people ask questions about, well, do I have the ability to pay the capital gains tax now, or lock in the rate that we currently know, so that I can lock in the benefits of the program, because I know what the rates are now? And the answer is the IRS has said no. The way the program is written right now, in 2026, when the capital gains tax is due on your old gain, you will pay the then prevailing capital gains tax rate. That's how the program is written right now. We don't know if that's going to change or not in the future, but that's how it's written right now. And of course, for the, after 10 years, whatever the gain it would be for your investment, then, you're going to owe or you would be excluded, of course, from the capital gains tax rate, regardless of what rate that would be. But if you don't invest through the fund, you're going to be subject to whatever the capital gains tax rate is at that point. So, I think the answer is yes, it does depend. But as long as those long-term capital gains tax rates stay in the mid 40s or less, it certainly appears that you're better off investing through the opportunity zone fund versus not.
Yeah, and John, let me bring up. I got something sent to me just a little bit ago, and this is actually in our deck. Hopefully, you're able to see this. But this is the tax benefits analysis, and this is exactly what you're talking about. It's something that we've put together. But this looks at the after-tax benefit of a QOZ, using those capital gains to invest in a QOZ versus a non-QOZ. And essentially what you have here on the left is you have the after-tax multiple, as if you invested $1 million of your capital gain into a non-QOZ investment versus taking that $1 million into a capital gains in the QOZ. And without going through line item over line item here, essentially what you get is a 75% more wealth that's created via a QOZ investment. And that's dependent on two things, really: the underlying return of the QOZ investment, but also what you just talked about, which is the tax rate. And the higher that tax rate goes up, the more, the greater the benefit is, because as you talked about in the beginning, the greatest benefit here is the forgiveness of taxes after 10 years and a day. So if that tax rate, if the long-term rates continue to go up, that benefit, the best one of the program, the forgiveness, continues to be more beneficial. So today's rates, we put this together based on the returns of the funds, and what we calculate is that there's about a 75% greater after-tax benefit by investing in a QOZ investment fund versus a non-QOZ investment fund. So I wanted to share that because I think it illustrates exactly what you were talking about in this chart.
Right.
So let's go on. That concludes really our presentation part here. But John, I know you had another, kind of 5 or 6 questions that you wanted to answer as well. And I've been looking through the questions that were emailed in, and I think you've done a great job of answering nearly all of them. So we also have questions that have come in through the chat box, so we'll answer these. But if you want to go over the 5 that you had teed up, let's start with those.
Yeah, there was a couple additional ones here that I wanted to cover, and I think they'll answer some of those. It's kind of a basic question, but we talked about this, this 5-year time frame for the 10% step up in basis, and then obviously the benefit of 10 years. But the question for an investor would be well, when does that actually start? And the answer is it starts the day you put your money into a qualified opportunity zone fund. So it doesn't start when the gain was recognized or so forth. It starts when you put that money into the fund. So that's so that as soon as you have that capital gain and you want to invest in the fund, you're better off doing it as soon as you can, because that's when your the 5-year clock for the 10% step up, and more importantly the 10-year clock starts. So it's kind of a basic question, but it's something that's important to think about. Another question that comes up from time to time is that what if you filed a tax return and you paid the capital gains tax on it, but now you determine, oh wait, I'm still in the 180-day window. I think I want to invest some money. Can you go back and kind of change what you want to do? The answer is yes. You still have to be within that 180-day window, but you will have to amend your tax return. So the answer is yes, you can do that, but you have to be within the 180-day time frame. We've had quite a few questions over the last 2 years about installment sales. A lot of individuals that would sell, particularly their business, they may do that with an installment sale. And the question would be well, can I, each year, I have to pay capital gains tax on that installment sale. Can I defer that? The answer to that is a resounding yes. So, if you have, let's say for this year, you're due, you have to pay taxes on a portion of that installment, you can elect to defer that. There are a couple of rules that you have to work through and make sure that, you're fully eligible, but generally the answer to that is yes, but the devil is in the details. So you want to investigate further. Another question that comes up a lot is, what if I have certain gains and they happen to be coming through various trusts that I've set up? Are those capital gains eligible? The answer is, as you can imagine, it depends on the type of trust. It depends on the facts and circumstances with it. I would say generally the answer is yes, more than no, but you really want to dig into the details to determine whether or not that's eligible. And then the final question that I also wanted to list here before we get into some of the other questions was, if you are in a partnership with others, the partnership can actually make an election to defer the gain versus sending a gain to you through a K-1 and then you decide whether you want to do it or not. So just keep in mind, if you're invested in various partnerships, that partnership can actually make an election to defer the gain. And then therefore you would not have gains coming out of that partnership for that. Instead, effectively, the partnership would be investing in a qualified opportunity zone fund. I think this is somewhat rare. I really haven't seen it done much, but it is certainly possible. And if you're in partnerships, you might want to check on that, because that is an option. That is an option for those partnerships to do. Although I haven't seen it happen very much. Typically, the partnerships just kick out the K1s to all of you as members, and then you decide whether you're going to pay the tax on that or defer the gains. So with that, Michael, should we move to some of these other questions that have come in?
Yeah, absolutely. We've got a flurry of questions that have actually come in, and I think there's a couple more here that came in beforehand that I'll ask quickly. It says, you know, that we talked about this a little bit. You addressed this, but how do you address the very real possibility that cap gains taxes have become much higher in 2026 when due? And I'm going to answer this, John. I think you did already, but from a fund standpoint, you know, it's our full intention to generate enough cash flow to pay for investors to pay those taxes. And the way we do that is really through refinancing between now and 2026. So as we build our assets, as we create value, our intention is to return about 25, 30, 35% of invested capital through refinancing and then cash flow between now and then. So even if tax rates do go up, we believe that we'll be able to return enough cash flow to be able to cover that obligation. So I don't know if there's anything else you want to add to that, John, but I think you've already.
Yeah, I think that's a really important point, because, you know, if I've got $1 million of the capital gains now, you always have to have earmarked that I need a couple $100,000 in 2026 to pay that, right? So if you're looking at, you're looking at the investment, well, how am I going to pay that? What is the opportunity fund going to do to help me pay that? Or am I going to need other sources to pay that particular tax? But I think that's a really important point, to bring up.
Yeah, and another couple questions people had asked beforehand was about refinancing proceeds and how taxes were going to be treated. And the fund operates from a tax perspective just like it would a non-QOZ fund in the sense that refinancing proceeds aren't taxable. So those come back tax-free. Any income that we do return as a result of operations will be shielded through depreciation to the extent we can. So it still has all of the great tax benefits of a non-QOZ fund, but wrapped in a QOZ fund so that your long-term gains are also protected in that sense.
Yeah, and one other point I want to highlight on there real quick, Michael, is that the program is really good for obviously capital gains, right? The tax on the old capital gain and the exclusion of tax on the appreciation. However, there are really no inherent tax benefits for the program for, I'll say, operating cash flow, that you're getting from the real estate, right? So like you said, you're running your fund just like a non-OZ fund. If that project generates cash flow from operations, whether we're talking about a real estate investment or an operating business, there is really no tax benefits through the program for that. It's strictly related to the capital gains reduction on the old gain, and then of course the exclusion on the appreciation. That there is no real, tax benefits if the project, if your real estate investment is just, doing extremely well and the cash flow is very robust, there is really no tax difference whether that's coming through an opportunity zone fund or not.
Right. Yeah. Thanks, John. So let me jump in. This is from an anonymous attendee. In 2026, if you have capital losses, this is paying the taxes to offset the QOZ bill that's due. Do you still have to make a cash payment to the IRS?
Boy, that's a great question. I think that the answer to that is going to be, if your losses are going to exceed the gain that you'd have to recognize, the answer would be no, you wouldn't have to, because you would net those.
Yeah, that makes sense. Okay, next question from Sydney here. Was hoping to confirm that I heard correctly. Assuming no change in the program, an investor would still have until 12/31/2021 and still qualify for the 10% reduction in already realized gains.
Yep, that's correct. Right. And we lived that last year because you had to have 7 years. So last year, at the end of the year, there was a rush for people to get money in so they could get that additional 5% up to the 15%. That's gone now. So we're likely to have that same kind of rush at the end of next year to get the full 10%.
Okay. This question came in from Albert. Are QOZ distributions free of taxes or taxed at ordinary income. So I think we answered this, but I don't know if there's anything else you want to say about it, because a lot of these questions, this one came in at 11:15 this morning. So certainly maybe before we addressed all these issues. Anything else you want to add there?
No, I would say generally the answer to that is it's not, well, for what you're talking about when you're talking about a refinance distribution, generally the answer is no, that's not taxable. The final IRS regulations have had some language, and there's been a lot of questions that various parties have asked about, well, how soon can I refinance? How often can I refinance, and so forth. And that's really the rules and the guidance that the opportunity funds have to follow. But generally, if you're operating the underlying real estate investment similar to a non-opportunity zone where, let's say you build a building, you get it leased up, and then at some point you do a refinance, to take out the construction lender, or you refinance a couple of years later, and that's customary for what you would do for this situation. That is not going to be by any means an inclusion event for that particular opportunity zone investor.
Okay. John, I don't know if you can believe this, but it's already been an hour with this fund. So we've got about, let's go another 5 minutes with questions. This was really for me, and said, can you compare, contrast the tax profile of the Income Plus Fund versus the QOZ Fund? Does Income Plus make QOZ investments? The Income Plus Fund does not make QOZ investments. The Income Plus Fund is our income-oriented fund, and we're investing in both preferred equity and equity investments. And our equity investments are in kind of core plus type investments, investments where we can add value, but they're already existing. So those investments don't qualify for QOZ tax benefits, and the fund hasn't been set up for those benefits either. But the Income Plus Fund is extremely tax efficient. We use a lot of depreciation to shield the income in that fund. But the difference is that when you invest in the Income Plus Fund, you're investing in a unit price. And if you buy that unit price at $10 and it grows to $14, when you sell at $14, you will be paying taxes on that. The QOZ investment, if you hold it for 10 years and a day, if the unit price goes from $10 to $15 to $20 to $25, it doesn't matter. Once you sell that, there will be no long-term taxes on that. So they're very different funds. And even from a risk standpoint, the QOZ fund itself is engaged in 100% ground up development, where the Income Plus Fund is in preferred equity and then more core stabilized assets on that side. So John, let me get to another question here. Going through these. Are net section 1231 gain and unrecaptured section 1250 gain eligible for tax deferral and reduction similar to capital gains? So this is called Stump the Tax Expert.
This was a huge question before we got the final regs. Was 12 qualified 1231, basically 1231 gains eligible? And the answer to that is they have said yes. Not only are they eligible on the front end when you invest in a qualified opportunity zone fund, so for the most part this is folks that have invested in real estate, but the benefit too is on the back end when Origen, when you're after year 10 you sell the property and you will have a gain. You could have some ordinary income recapture, depreciation recapture, but the depreciation recapture or the 1231 gain that is not related to ordinary income also will be a benefit at that point, meaning that it is additional gain that would be excluded. So this is a good question. It has come up a lot. There was a lot of speculation early on, but I think that the IRS has done a pretty good job that has answered this. And before I forget, I just want to mention that some of you have probably seen it. The IRS has, if you can just Google it and see that they have a frequently asked questions website or a page on their website, and it actually has a lot of really good questions, many of which we've answered today. And it does appear that the IRS is continuously answering those or updating those, I should say. So there's questions on there related to this and other things that we may or may not have covered today. But that particular 1231 item has been, I think, answered pretty well. And I think it's a big benefit to not only investors, but also to the underlying qualified opportunity zone funds.
So John, here's a specific question from one of our investors. Thank you. We get Origen K1s in March. Does that mean we can choose our 180-day period, either 180 days after 12/31 of the prior year or 180 days after the March 15th date of the current year?
So when you get the K1s doesn't matter. That has no bearing at all on for the 180 days, and the IRS has made that very clear. So whether you get your K1, on January 2nd, or unfortunately it doesn't come till many months later, that has no bearing on the 180 day. What has bearing on the 180 days is basically 180 days from the end of the year, 180 days from when the timely filed tax return is due, right? And then effectively 180 days from when it occurred. So, for example, Michael, let's say one of your investments did something that created a capital gain on November 1st. Well, technically that, I'm sorry, one of the investors did something that created a capital gain on November 1st, and it was through a partnership. They would have 180 days from that day as well. So, but again, going back to the question of when your K1s come out, that is irrelevant. So that does put pressure on, I'll say, the opportunity funds, but more importantly, it puts pressure on the partnerships that you're in, that they issue K1s earlier, or that you at least know what the capital gains are going to be. Because if that's issued really late, you could be out of luck. If your K1s come out in late June, your 180-day window, it's possible, could be either expired. I will say, because of the March 15th date that they've provided for, you do get, really you're basically looking at almost mid-September for that. But there are situations, I'm sure that some of you on the phone have heard, where you get your K1s very late, and it's problematic for this program.
John, next question. This is a quick one. Let's try to get through a few of these. We're already over our hour. But if I harvest gains today, is there a waiting period to then invest those gains into a fund?
It all comes down to the 180 days. So if you harvest gains now, again, it depends on, are you selling something that is generating the gain, or are those gains coming through a partnership or a corporation? So if you're harvesting gains because you're selling a whole bunch of stock right now, well, your 180 days starts now. That's basically how it works. So you need to be mindful of, it's very possible you could have had capital gains in June, and then in September and December and so forth. And you need to be mindful of those capital gains when the 180-day clock starts for each of those.
Yeah, I think the question might be, if they sell a stock today, can they invest in a QOZ fund tomorrow with those gains?
Yep, and the answer is yes.
Okay.
Yep.
So this is a question for me from Scott. Is there some paperwork I need to get from Origen to prove that I've made an investment in a QOZ fund? So Scott, anytime somebody invests, we send back a confirmation through our fund admin about your investment. And to my knowledge, and John, you might want to opine here, but that's all you need from us in terms of showing that you made the investment, and it has the date of the investment, the amount, and everything else.
Yeah, what you'll need to put on your tax return as an individual investor in a qualified opportunity zone fund is, of course, you need to note what day you actually invested in the fund. You also need to label that it's a QOF investment, and then you're going to need the EIN number for whatever that particular investment is going to be, and then you list the amount that you invested, of course. So if you put in $100,000 or whatever it might be, you list that on there. But that's really all that you need at this point.
Yeah. All right, let's take one more question, John, and I really apologize to everybody, if your question did not get answered. We will try, we have a list of all your questions, and we'll try to get back to you. And what I have up on the screen is John's information here. He's the tax expert. If you certainly have a question about taxes, John is more than happy to answer those. And then if you have a specific question about Origen, our funds, I'm happy to answer those too. And you can email me directly at michael at origininvestments.com, or you can go to our website and connect with one of our investor relations representatives. So the next one, and we actually get this a lot, but this is about using mixed funds within the fund. And it says, can you invest into a qualified opportunity zone fund, even though you may not have enough realized capital gains to cover the investment amount? Example, if they invest $50,000 of capital gains, but they want to invest $100,000, can they do this? And John, maybe you can talk about mechanically how that works from a filing and tax perspective, because we get people all the time. And, I'll say that you can actually invest in the QOZ fund with non-capital gains. It's a great investment. You're just not going to get any of the tax benefits that we talked about today.
Yeah, so this is a question that comes up all the time for both funds and for investors. And I will say that most funds, and especially when I advise most funds, if they're setting up funds, is that the fund itself should only accept qualified capital gains, meaning that we want to keep that qualified opportunity zone fund pure such that it only has capital gains. Okay. Now, what generally happens is that qualified opportunity zone fund actually invests in a partnership, and that partnership is the entity that, talking about real estate here, will buy the property and build the property and lease it and so forth. Now that underlying partnership could also have other investors besides just the opportunity zone fund, and in most situations, that's where the other equity would come in to that, to basically that underlying real estate deal. Now, Michael, you had mentioned that you do accept, non-capital gains through the fund, and some funds will do that. A lot of funds, though, will say, nope. If you want to invest in this underlying real estate deal, we have a separate fund here for non-capital gains. So you could have a real estate partnership where one of the investors is the opportunity fund, and the other is basically the non-opportunity. So if I've got $100,000 worth of capital gains, I put it through the opportunity fund, and let's say I have $200,000 of non-capital gains, but I really like the deal, I would invest it through, a different entity that's not a fund, but it would go to the same underlying real estate
Yeah.
deal.
All right. So I lied. I'm actually going to take one more question here. This one's from Bill. If you invested, and I'm taking this question because we get this quite a bit from investors, and a lot of times there's a timing issue between when they want to invest and some nuances around the fund, and then when they're going to realize their capital gains. So the question is this: if you invested in a QOZ fund in mid 2020, can you retroactively assign capital gains realized in late 2020? I'm going to assume that's it, to that investment via Form 8949.
So is the question that you're putting the non-capital gains in first, and then later on you're going to take out the non-capital gains and put in the capital gains? Is that what the question is?
So the question is about retroactively assigning capital gains. So I'm assuming that an investment has been made, and then you're assigning capital gains via Form 8949 later. So I guess the question is, you've invested and then you've realized capital gains after the investment, and then trying to retroactively assign those to your investment, right? And so this comes up because one of the things that's happening in our fund is that we are marking it to market at the end of the year, and certain people, and by the way, this is for everybody who's on this, our fund will not be marked to market until January 15th. So for those of you who are rushing to get in, because we know that, some people are, they're actually going to realize capital gains on January 1st, 2nd, 3rd, 5th. So we've actually extended that out to the 15th, when our fund will actually be marked to market. So John, if you want to opine on that, and this will be the last one.
Yeah, so I think that really what it boils down to is, let's say, Michael, you say, hey, I want to accept your $500,000. And if I'm the investor, I say, well, I don't have $500,000 of capital gains yet, but I will several months from now. But here's $500,000, right? And when I get the capital gains, I might have to do something to kind of switch the money in and out, right? The key would be I think the answer is, yes, you technically could do that, but remember that you're going to fill out the tax form, your own 8949, and say, I invested in the fund as of this date, right? Which is the later date, right? Because on that same form, that 8949, that's going to have the date of when that capital gain was, recognized to you. So what you can't do is say, well, I don't have capital gains until November, but then I'm showing here on this form that I invested in the opportunity funds in June, right? That's problematic. So the key would be, what I've seen this happen in other areas where, if the fund needs money to do certain things, oftentimes what I've seen individuals do, if they don't have the capital gains yet, is they actually technically say, well, I'm loaning money to the underlying partnership, or I'm making an equity investment in this underlying partnership. And then, however, once I get my capital gains and it goes through the Opportunity Zone fund, then I'm going to get redeemed of the money I originally put in there. That's probably gets a little more complicated than we want to cover here, Michael, but I think that kind of comes down to how you are actually operating your fund and what you're allowing those investors to do.
Yeah, definitely a nuanced scenario, and I know a lot of people have gotten into this or have looked into this as well. So thank you for that answer. And John, this has been a real pleasure. I know I learned a lot today about taxes, and based on the amount of interest we've had from the number of people who have signed up for this webinar, and then the questions, and we haven't gotten to a lot of them today. We're going to definitely have you back in Q1 to go over this again and continue, because there's just so much complexity, or I should say seemingly it's complex, right? There's a lot of nuances, but it's actually a very simple program when it comes down to it. But there's certainly nuances within the program. So we appreciate you coming on today as our tax expert. Again, we've enjoyed a great relationship with you, and thank you so much. And for anybody who's attending today, again, if you want to reach out to John directly, his email address is jhoffman@bracketpartners.com, and his phone number is right there on the screen as well, 312-502-8711. And we thank you very much, and I think that's it. Any closing words, John?
No, I want to thank everybody's time, and just keep in mind that everything is evolving here, and we'll have more questions and hopefully more answers as the months continue on into 2021.
Certainly more questions. Yes. Thank you, everybody.